Last week was Jobs Week. We had two major employment reports. On Wednesday was the ADP report, and on Friday was the BLS government report. So both of them showed a weakening economy. However, as you probably noticed, we have not seen a general economic decline, a general widespread general recession yet, although it's been talked about in the news and the media and the economists for the past year and a half. What we have seen, and what seems to be coming to fruition here, is what's called a rolling recession. A rolling recession, meaning that we have specific sectors of the economy that have dipped into recession territory, like manufacturing, for example, like the mortgage industry, for example. I mean, there's certain sectors that have had a recession, if not a depression, over the past year and a half, and other sectors that have been doing just fine, like leisure and hospitality, have been doing great. So it's an interesting economy, this rolling recession thing. We'll see how long that lasts, if it turns into a general broad-based recession or not, and we'll find that out hopefully sometime soon, right? It'd be better to get that over with if it's going to happen. But the good news for interest rates is that anytime you have weakness in the jobs numbers or an inflation coming down, which we haven't seen a lot of lately, but weakness in the jobs number is certainly helping the bond market say, hey, there's more of a possibility the Federal Reserve could pay attention to this if this continues to weaken on a broader basis and have more impetus and more desire than to be able to scale back interest rates and pull them back sooner than later. So let's take a look here. I want to show you what I'm talking about starting with the ADP report from last Wednesday. Okay, so here's the report, kind of synopsis. The ADP report, ADP is a private payroll service, right? So they're such a large company, they have access to millions, right, of employees across the country and have enough data to be able to put together statistically relevant reports on employment. And sometimes they match up closely with the government report on Fridays, and sometimes they don't. I'm going to show you here where it's close and where it's far off. So where it's close is the number of new jobs created. For April, they showed 192,000 new jobs created. Where it's far away from the BLS report, and I'll show you here in a minute, is this small company where my cursor is there. It says small employees, number of jobs created for small employees of 1 to 49 employees, small companies, 38,000. That's not many. That's pretty anemic, right? That means small companies are really not growing much. Medium companies growing a little bit better, 62,000 jobs last month, and then large companies added almost 100,000 jobs last month. And then there's other pieces of information here, like leisure and hospitality sector of the economy added 56,000 jobs, construction added 35,000, probably likely because of the time of year, et cetera, right, to build things. And then job stayers and job changers here in the annual pay increase section. It's not quite as lucrative to change jobs. Even if you stay or switch jobs, the increase in pay is starting to come down. So we're starting to see a little bit of weakness there in wage increases. So that's the ADP report. Kind of interesting. Now, how does this compare to the BLS report? So on Friday, the BLS report came out. It showed there were 175,000 new jobs, so a little bit weaker actually than the ADP report, which is the opposite of normal. Usually ADP is more conservative than BLS. So this was kind of the opposite, kind of flipped. So 175,000 new jobs created instead of the 240,000 estimate. So way under the estimate. And the markets, of course, take a look at these estimates and reality on the BLS report. That really is a market mover. And I'll show you how that moved the market here in a minute. They also had some revisions to March and February, a total of 22,000 less jobs for March and February than they had reported. This is, normal, right? Unfortunately, we constantly have these lower revisions than what they initially report. And this is holding true this month and will probably continue. Unfortunately, they seem to always overestimate the number of jobs created. And then what's interesting here is this birth death model. Remember how I said there are areas where these reports are really divergent. And this is one of those. Birth death doesn't talking about human beings here. We're talking about businesses, small business, birth and death. Okay, so they're trying to figure out, okay, of the businesses that are out there, which ones are still alive, which ones still have active LLCs or whatever the case is, right, where they're getting this information, which ones have died off. And the way the BLS does it is not as accurate as ADP, honestly, because they are really imputing a lot of data based on public records of companies that are closing down and opening, right, based on formations of companies. And so they're saying there were 363,000 new companies that were created in April. That's what they're saying. But ADP only showed 38,000. That's a huge difference, right? So if we had 363,000 new jobs created because of new companies, right, created, as opposed to 38,000 new jobs created from ADP's standpoint with small businesses, who's right? I tend to actually trust ADP more than the BLS on this one because their data is more hard. This is hard data and factual data. So that's a huge difference, though. If you took the difference there, that would show, I mean, if you took away the 363,000 new jobs created that BLS is showing from the new jobs, we would actually have like a loss of 150,000 jobs on the report from Friday, which would have been a huge upset, right? So it's just weird, how these statistical models work, and the fact that they sometimes, it seems the BLS uses more imputed data than actual factual data, and that there's such a huge disparity between the two. So I'm not trusting necessarily that the economy is even as strong as BLS is saying it is the bottom line. That's what I'm trying to say. The household survey, that was the business survey. Now the household survey has the unemployment number. And we all watch for the unemployment rate. What's that going to do? So here's what happened with unemployment rate, the U3 number. It went up a little bit from 3.8% unemployment to 3.9% unemployment. And then the U6 number, which includes people who aren't actively looking or who are actively looking for a longer period of time, went up from 7.3 to 7.4%, which is the highest since November 2021. So it is looking like the economy is weakening. Now, drastically weakening? No, but I don't know if I trust the numbers. I mean, it just seems on Main Street, if you will, or around, my own anecdotal data from, seeing what's going on, at least in my community, is that it's not as strong as even the BLS is reporting, that the economy has some weakness here, some underlying weakness that could start showing up more and more in subsequent months' reports. So that's where I'm coming from with this. I thought it was interesting to see the difference between ADP and BLS. So how did this affect rates? Let's talk about that for a second. Here's the charts for today. This is your universal mortgage-backed security chart. Let me scroll down so you can see the candlesticks going back 3 months. As you can see, we had as you know, especially if you're a real estate agent speaking with me or any other lender, we've had a rough time with interest rates, right? Since April 10th. April was not fun. So we had some data that indicated that inflation was not coming down like it should have in the CPI report. That's what this April 10th report was CPI for March. And that was not what the markets were expecting to see inflation go the wrong direction on the headline. So you had mortgage-backed security prices just fall off a cliff. And then it kept getting worse, right? And then kind of vacillating in wide swings in this range over the last couple of weeks. But since late last week, we've seen some improvement. And especially since, Friday's jobs report came out that confirmed that there was some weakness. We saw an increase and popped up above this Fibonacci level. And then today we've seen some, and then Friday, of course, following through above that 25-day moving average. Today we're pretty much the same range, but we popped above that 25-day moving average on Friday, and then also above the 200-day moving average on Friday. And we bounced off of the 100-day moving average Friday and today. So now we're stuck in a new range here. But if you look below, and this is where it gets a little bit technical, but the technical analysis, this is called the stochastics, okay? When the stochastics turn and show some movement, some momentum like this, it indicates that there is some momentum to the mortgage bond market, to prices continuing to improve. So we could see some follow through momentum, hopefully enough throughout the next week to get us above this 100-day moving average into a new range and better pricing and better rates. But we have seen a nice improvement in rates over the last 3 business days, and we're hoping that will continue. So that's the update for today. I just want to share that with you so you understand what happened with the employment reports and how that affected interest rates. It's helped, okay? A little bit weaker, 175,000 jobs as opposed to 240,000 they were expecting was enough of a weakness to cause the bond markets to go, oh, okay, maybe things aren't as rosy on the employment side as we thought they were initially. So we're seeing some improvement. Let's hope there's continued follow through, and I'll give you an update next Monday on what happened throughout this week. We have a number of bond auctions happening this week that the government is trying to raise more money, sell more debt. So those could be fairly substantial bond auctions. There are large amounts that the government is trying to sell right now to fund its operations, and those could be market movers. So we'll see how that affects this week. And again, hopefully the stochastic momentum that we have will continue, and we'll see more improvement. In the meantime, have a wonderful week, and we'll be in touch next week.